Good evening. This side, Rahul Magan here is a Group Chief Executive Officer, Treasury Consulting, and a second year law student. Yesterday, I was discussing with my friend who lives in United States about the global recession. We were discussing about that how Federal Reserve continuously increasing the rates, which end up taking hundred thousands of jobs. We were also discussing about the global debt, which already touched approximately 307 trillion US dollars, with debt to GDP of approximately 336%. Then one interesting point came in our discussion is that how we can tame the rising interest rate. Because both me and my friend are clear on one point that this interest rate would continue to hike. I also believe that this interest rate cycle would continue to be high. The reason being Federal Reserve and other central banks are trying to tame inflation by hiking the interest rate. But the hard reality is that the inflation is going up. And this inflation would continue to go up because of the Russia-Ukraine war, because of the many geopolitical issues. So I told my friend that the right way to tame this inflation is when you would be issuing the convertible bonds. And my friend said, after some deliberations, that the governments cannot have convertible bonds. And I agree, his government cannot have convertible bonds, but at least corporate entity can have convertible bonds. Then he decided on my point and we agreed that I should have a video in this regard. Ladies and gentlemen, I'll keep this video very short and to the point. I strongly feel that the interest rate cycle would continue to move up. I may not be surprised if I see the Federal Reserve interest rate at 7%. Let me tell you very honestly. I may not be surprised even if I see this at 8%. Even if Federal Reserve increase the interest rate cycle to 8%, I may not be surprised. But having said that, one thing which is definitely there, that the corporates who want funding, because United States is the largest debt market of the globe. It is the largest securitization market in the globe. Rather, the kind of derivative instruments traded in United States forget traded anywhere. Henceforth, the people, those who sit in India, those who sit in United States, London, Singapore, maybe different parts of the globe, if they wish to tap the New York markets, one thing they need to learn is the higher interest rate. Now, to tame the higher interest rate, you can have convertible bonds. But in this convertible bond, you need to have an option clause, which means if I take today's date, which is 26th September 2023, then the Federal Reserve interest rate is approximately 5.25%. It may touch down to 7% also. And when you issue a convertible bond, then you are supposed to have an option clause in place. So you can issue the convertible bond by saying that, ladies and gentlemen, if the Federal Reserve interest rate will touch 6%, then we would be converting this bond into equities. And what is equity? The equity of our company. The conflict here is that the floating interest rate structure. Gone are the days when convertible bonds were used to issue at the fixed rate. In fact, gone are the days of the fixed interest rate. Now, majority of the IR world, IR means interest rate, majority of the IR world is at the floating rate. Of course, one thing I completely agree and appreciate is the floating rate structures vary from country to country. So Hong Kong have their own structure, India having own structure, Singapore having own structure, US having own structure, London own structure. So everyone having its own structure. But one important thing is that all structures are tied with a floating index. Of course, without specifying any names, some indexes are linked with inflation, while many indexes are not linked with inflation. That's a little bit a hard reality. I feel that if a corporate wants to tame the debt market, and specifically for a longer period, generally the corporate tame for two periods. One is the very shorter period, which is also known as short-end curve, and one is the very longer period, which is known as long-end curve. The shorter period is known as commercial paper, while longer period is known as bonds or notes. Generally speaking, a hike in interest rate is having minimal impact in commercial paper segment. The reason being, first of all, it is discounted instrument. That's more important, which means they are issued at cost. Number two, they are for a very shorter period of time. While bonds, they are not discounted instrument. They are issued for a longer period of time. Henceforth, real interest rate is a key consideration there. But ladies and gentlemen, one thing which I am clear is that to tame the hike in interest rate, and specifically for the corporate sector, who continues want bond, in fact for NBFC also, non-banking financial corporation also, in fact for banks also, convertibles are the only option. Because this interest rate cycle would continue to move up. Having said that, there are variety of convertibles we are having, which we are not covering in this video. Having said that, one should understand the legal framework of that convertible also. That's yet another important thing to learn. This is Rahul Magan from Treasury Consulting. You have my number 9899242978.